Hello everyone and welcome back to our FDM journey. I hope you're as excited as I am because today we're diving into something that will completely change how you see price action forever. Let me start with a bold statement. You may have heard about support and resistance 1,000 times before, and that's exactly why it works. I know you. You're probably thinking, really, support and resistance again? That's so basic, man. But here's what I want you to understand. By the end of today's lesson, these aren't just lines on a chart. They're psychological battlegrounds where fortunes are won and lost every single day. Today we are exploring the first dimension of FDM levels, and I'm going to show you why mastering this simple concept is actually a secret weapon in a world full of traders chasing complicated systems. Let's start with something that might surprise you. In all my years of trading and teaching, I've seen traders dismiss support and resistance as too basic while they chase after fancy concepts with impressive names. But here's the reality. Markets are made of crowds of humans and algorithms making decisions, and they naturally custom their orders at certain price levels. Think of it like this. Imagine you're at an auction house. When a valuable painting comes up, bidders just don't randomly shout numbers, they cluster around psychological price points. For example, 1,000, 1,500, 2,000, the same thing happens in the markets. But instead of art, we are trading currencies. And instead of an auction house, we have a global marketplace. Now, over the years, traders have invented fancy new names like order blocks, fair value gaps, supply and demand zones, premium and discount zones. But let me tell you a secret, they're all just support and resistance dressed up in new clothes. It's like calling a car a ground-based transportation vehicle. Sounds more impressive, but guys, it's still just a car. So what exactly are these levels? Let me break it down simply. Support. What's support? It's like the floor of a building. It's a price level where buying it was strong enough to prevent price from falling further. Traders may see value at this price and step into buy. Now what is resistance? Resistance is like the ceiling. It's where selling pressure becomes strong enough to prevent price from rising higher. Sellers think the price has gone too far up and start taking profits or enter short positions. Now before we continue, I want you to think about your own trading. How many times have you seen price bounce off the same level multiple times? That's not coincidence, that's psychology in action. Alright, let's get practical. Here's how to draw support and resistance levels in FDM, and I want you to follow along. First, start with higher time frames. Think of it like looking at a map. You start with the big picture view before zooming into the streets. Daily and weekly levels are like major highways. They carry more traffic and have more influence because the institutions that are moving the markets, they are focused on the higher time frames. Second, focus on candle verticals, not just the wick. Wicks are like someone quickly peeking into a room and leaving. The close is where they decide to stay. Vertical closes near the same price level carry much more weight. Third, use line charts for clarity. I know candlestick charts look more professional, but sometimes they create more noise. Line charts are like putting on reading glasses. Suddenly, everything becomes much more clear. Fourth point, and this is very crucial, we mark zones, not exact lines. Price doesn't respect exact numbers like 1.200. It respects areas maybe 1.19990 to 1.2010. Think of it like a target in archery. You don't need to hit the exact center to score points. The psychology behind levels. Now here's where it gets really interesting. The psychology. These levels work because of human nature, and human nature doesn't change. First is market memory. Traders remember emotional highs and lows. If your USD crashed from 1.200 6 months ago, and guess what happens when it approaches 1.200 again? Traders remember the pain and react accordingly. And there is the self-fulfilling prophecy. The more traders who see a level and prepare to trade it, the stronger it becomes. It's like everyone agreeing to meet at the same coffee shop. The more people who know about it, the busier it gets. We also have emotional anchors. Support levels breed optimism. Hey, it bounced from here before, it will bounce again. Resistance levels breed fear. It couldn't break through last time, it probably won't this time either. And here's something powerful. Role reversal. When support finally breaks, it becomes resistance. And when resistance finally breaks, it often becomes support. It's like opening a door that swings both ways. The same level that once kept the price up, now it keeps it down. Liquidity grabs versus higher time frame tests. Now let me address something that confuses a lot of traders. There are certain spikes beyond support and resistance levels. Many traders panic and call these stop hunts or market manipulation, but most of the time they simply tests of higher time frame zones. Picture this scenario: you're watching a 15-minute chart and you see a price break below what looks like a strong support. Your first instinct might be to panic and think institutions are hunting stops. But step back and look at the daily chart. Price might just be testing a major demand zone that has been respected for weeks, if not months. It's like watching someone's daily routine through a keyhole versus watching from across the street. The keyhole gives you fragments, but the street view gives you context. Let me share the most common mistakes I see traders make with levels, because I don't want you falling into these traps. First mistake: marking too many levels. Your chart shouldn't look like a spider web. If you have more than 3 or 5 major levels on your chart, you're probably overdoing it. Second, ignoring time frame context. A level that matters on the 1 minute time frame might be completely irrelevant on a daily chart. It's like worrying about a puddle of water when there's a river nearby. Third, relying only on wicks. Wicks show emotion, but closes show conviction. You need both to get the full picture. You use wicks and body closes as well. FDM's approach to levels. In FDM, we treat levels as decision points where market sentiment shifts. We consider historical importance, those major highs, and those that everyone remembers. We are sensitive to sessions. London behaves differently than New York, just like different neighborhoods have different personalities. We look for confluence between wicks and body closes to capture both emotional extremes and confirm decisions. And we are always aware of role reversals because they offer some of the highest probability setups. The emotional importance: remember, levels aren't just numbers on your screen, they are collective emotional anchors. At support, buyers defend their positions with hope and determination. At resistance, sellers dominate with fear and profit taking. And these levels create mental landmarks that traders carry forward. They are subject to anchoring bias. Traders fixate on these biases even as market fundamentals shift. How levels fit into FDM. Now here's how levels fit into our complete 4-dimensional framework. As you know, the first dimension is levels. This is where the battle occurs, the foundation of everything. The second dimension, structure. This is how price behaves when it reaches those levels. We've achieved a level. Now what we want to see is how price is behaving at that given level. Dimension number 3, time. This tells us when the participation is the strongest. Now the fourth dimension, dimensional alignment. This is when we trade because all dimensions agree. Master checklist. Before you act at any level, ask yourself these questions. Has it caused major reversal before? Does it align with higher time frame structure? Has it been inspected multiple times? Is it likely to be tested during the active session? Has it flipped lows between support and resistance? If you can't answer yes to the most of these, wait for a better setup. Addressing the fancy terms. Now let me address all those fancy terms you hear on social media, whether someone calls it order blocks, fair value gaps, supply zones, demand zones, liquidity pools. They're all reduced to support and resistance. Don't get distracted by the packaging. Focus on the principle. Alright everyone, let's recap what we've covered in this crucial lesson. We learned that support and resistance aren't just basic concepts, they're psychological, battleground, human nature. We covered how to draw them properly using high time frames, focusing on closes and marking zones rather than exact lines. We explored the deep psychology behind why these levels work, including market memory, self-fulfilling prophecies, and emotional anchors. We discussed how to differentiate between noise and genuine higher time frame tasks. We covered common pitfalls to avoid. Most importantly, we learned that all those fancy trading terms ultimately come back to good old quarter resistance. Here's what I want you to remember. In a world where everyone is chasing the latest, most complicated trading strategy, mastering this fundamental concept gives you a massive edge. While others are confused by printing indicators and fancy terminology, you'll have clarity. Your homework for this week: go to your charts and practice identifying clean, obvious support and resistance levels on a daily time frame. Start simple, build confidence, and remember, sometimes the most powerful tools are hiding plain sight. In our next lesson, we'll dive into Dimension 2 structure, where I'll show you exactly how price behaves when it reaches these levels we've identified today. You're building something special here, and I'm proud of the progress you're making. Until next time, keep it simple, stay disciplined, and remember, you're not just learning how to trade, you're learning to read the collective psychology of the market. I'll see you in the next lesson. Thanks guys, and take care.